for you all to be spending your valuable time, it is quite the honor. So I'm going to do the very best I can to make sure that this time is valuable. And the times are crazy right now. So listen, we have opportunity. I wrote the book, Money in the Streets. It's about finding opportunity. There's a big opportunity right now to differentiate yourself, to elevate yourself, whether you're in real estate or in mortgage. People are confused. They're concerned as to what's going on. So you have to be that guiding light. And I promise you it will pay dividends for you. So we're going to try and take apart what's happening in the marketplace step by step by step and show you what we could do right now to make some important differences and changes to what we're doing daily so that we can win, we can gain more market share, and most importantly, change the lives of people for the better that we come into contact with. So look, I know rates have gone crazy, but there's a reason for that. And we're going to talk about that together. There's talk about recession. We started this talk about recession back in the fourth quarter of 2021, and now it seems like everybody is jumping on our bandwagon. Many of you have heard me talk about it since then as well. We said that rates were going to go up. We put in our forecast. We told you the reason was because of inflation, and we saw inflation rising, and sure enough, that's happening. But there's also a light at the end of the tunnel here. Even with recession, real estate values have done very well. And I know a lot of customers right now, they're worried about housing bubble, and they're coming to you for explanations as to why. So let's take the next 45, 50 minutes and let's really focus, because we're going to talk about here is important. It's important not only for you to be able to understand it, but you have to be able to teach it. And I promise you, that's going to separate you from everyone else. So listen, just like you, I'm being pinged with my phone, with my texts, with my emails, with all the social media. Yeah, we all get that. But I think it's important for you to give 100% attention, maybe take a pen and paper and take some notes, because you want to go back and review it. We're going to talk about things that are high level, but we're going to make it so that it's understandable. So first things first, what the heck is going on with rates? And what about the Fed? So interest rates are mainly going to be impacted by inflation. And that's the first step. You know, most people in our industries don't know what affects interest rates. They think, oh, it's the Fed, it's this, it's that. It's inflation. So let's understand why. Now, what I'd like you to think about is how inflation, what's the definition of it? It's too many dollars chasing too few goods. It's happening right before your eyes in the real estate market. You have too many buyers, which represent dollars behind them. So too many dollars, too little inventory, and that's making real estate values inflate or go up. When we take, and I just want to make sure, because I'm seeing some stuff, some people saying about volume. I'm going to make sure my volume is good. Volume's good, everybody. Katrina, Steve, volume's okay, because I'm seeing some stuff come across. I want to make sure we're good.
It sounds great to me, Barry.
Okay, good. All right. So when we look at inflation, it's too many dollars chasing too few goods, just like you're seeing in the real estate market, and that's what's causing prices to inflate. But when it happens with the things that we need to purchase for our daily lives, and that starts to go up, and oil prices go up, and gasoline prices start to go up, well, that creates a lot of pain in the economy. People don't like that. We don't like it, right? And if the pace of inflation, costs of the things we need, go up faster than our incomes go up, well, then it puts us in a position where our standard of living is dropping, and nobody wants the standard of living to drop, right? So the Fed is charged with keeping inflation in check. Now, they've done a really bad job of it, because literally they've been asleep at the wheel, watching inflation go from under 1.5% to about 8% in a very short period of time. The Fed Chair Jerome Powell and other Fed members, they thought that this was transitory. It wasn't going to stick around, but they were wrong. They dropped the ball. I mean, we were saying that there's no way it was transitory, that it was sticky, but unfortunately the Fed did not take action. And now what they're going to try and do is take some severe action to make up from the mistakes that they had all put us in. You know, a quick anecdote here. I used to take flying lessons years ago, and the instructor made it really clear to me that you do not want to make sudden movements. You want to make gentle movements when you're flying an airplane. Well, when you're flying an economy, and if you're charged with the most important price in the world, and that is the price of money, the United States dollar is the reserve currency of the world, then it's good to try and do that in a thoughtful manner. And it seems to me that the Fed has continuously put us in boom bust cycles. So why does inflation, which we know is out there, Why does that drive interest rates, and why do interest rates go up? Well, I want you to think about this. If you are in the business of doing loans with your own funds, or if you manage a fund and they're doing mortgages, imagine that you're putting out mortgages out there, and mortgages are going to give you back a payment that you're going to receive for a long time, 10 years, 20 years, 30 years. So you're going to be receiving that payment. Now, that payment doesn't change, it's fixed. But inflation makes the cost of things go up over time. So it's a thief. It's taking that fixed payment and it's eroding its buying power over time. Well, if inflation is very low, you're not going to be greatly impacted by that. So therefore, you can afford to offer a low interest rate. But if inflation starts to rise like it has, your only defense is to start at a higher perch. So you can then offset the more rapid erosion of that because inflation is rising. So your buying power is going to get eroded. Let me offset that by charging a higher interest rate. And that's exactly what's happening right now. So inflation's driving interest rates. Now, the Fed actually wants to curb inflation, and they have their main tool that they can do this is raising what's known as the Fed funds rate. So if the Fed wants to slow things down, why would raising the Fed funds rate slow that down and curb inflation? Now, the Fed funds rate does not affect mortgages directly. The Fed funds rate does directly affect things like home equity lines of credit, credit cards, car loans, and the big one is commercial loans, business loans. This is where you're talking tens, hundreds of $1 million transactions that are being borrowed that are going to be impacted by what the Fed funds rate does. Those are very short-term rates. Now, the reason that it's so important is because if you're a business and you want to acquire another business or build out a facility, when you're going to borrow tens or hundreds of millions of dollars, if the cost to do so, because interest rates go up, becomes prohibitive, then you're going to borrow less. You borrow less. When you borrow money, it creates money into the economy. That means it's draining money out of the economy. Fewer dollars slows inflation. In addition to that, if you start to get more money in your savings accounts, people might now start to save more money or squirrel it away. That takes money out. And all of these things historically have brought the economy to a slower level, but also inflation to a lower level. Now, we didn't have to go through this. If the Fed would have taken the incremental steps initially, they didn't have to do this. And now they're looking at taking some really important steps and big increases in interest rates. But even so, if we think that through, if the Fed hikes interest rates and is successful in curbing inflation, well, mortgage rates should drop. And historically they have. And this time they should too. But there's one other thing, and it's called the Fed's balance sheet. So the Fed's been out there doing quantitative easing, or QE. That's buying mortgage-backed securities, it's buying mortgage bonds, it's buying treasuries, and it's adding them to their balance sheet. And that's gone up to $9 trillion. $9 trillion. Now it's gotten so big, what we're hearing members of the Fed say is, look, we have to allow that to slow down. So one of the things that they've done as of a couple of weeks ago is stop buying new mortgages. But what they've been doing all along, and where the big money has been, is the reinvestment of their current holdings. Let me explain that to you. So the Fed's got all these mortgages. And if somebody refinances their home and pays off their mortgage, well, the Fed would now get that payment and their balance would drop. Even the monthly payments that they receive from individuals making their mortgage payment, a portion of that, remember, is principal. So you know how when you make your mortgage payment, you make a payment and your balance drops. Well, imagine these trillions of dollars of mortgages, it makes the balance drop a lot. So between the principal payments and between payoffs from selling a home, refinancing, that would come out to about $70 billion a month that the Fed's balance sheet would drop, but they're not letting it do that. Their balance sheet would be called runoff. It would allow it to run off. They're taking that $70 billion a month and they're purchasing more mortgage bonds to keep that level the same. So they don't get that runoff. They keep that level the same. So the ones that are being off the balance sheet because they're paid off, they're buying new ones to keep their balance the same. And this is where it gets crazy, because the Fed is thinking about starting to allow their balance sheet to run off without investing more. Now, the responsible way to do it would be to do this gently and incrementally. If you're going to be hiking rates and doing something else, maybe let's go a little bit gentle. But Lael Brainerd, who is a voting Fed member, there's 19 members of the Fed, 12 of them vote, but 3 are very powerful. Of course, you know Jerome Powell, he's the Fed chair. But then you have the New York Fed president, John Williams, very powerful. And the other is Lael Brainerd, who is like the vice chair. And these three carry the most sway. They only get one vote each, but they are the most influential. So now Lael Brainerd gets on CNBC yesterday, and she says that she wants to see the balance sheet runoff happen very rapidly. The market went crazy. Mortgage rates went up 0.25% yesterday, and then another 1/8% today, based upon that, because that would cause disturbance. That's just like that old flying lesson. You don't want to make these sudden movements because you get into trouble that way. Reminds me of a story that we can all relate to, is when you see somebody who's a driver going very fast in the passing lane, the left lane, but maybe they're asleep at the wheel, just like the Fed's been, and they're about to miss their exit. But now they want to get off this QE exit. And they realize that the exit is all the way to the right, and they cut off all traffic to jump off the exit. That's how accidents happen. And what's going to happen here, team, is the Fed's going to cause a recession. The Fed causes boom and bust, and they're going to cause a recession. So let's talk about this, and let's see how this recession will impact us and affect us, and how what the Fed's about to do can give us some clues as to which way the market's going to go and how we can gain market share and capitalize. I've got to tell you, there's good news at the end of this, okay? So I know we're going through a period of time right now, but that's the way to think about this. This is a period of time, and you're actually planting tomorrow's refinances, okay? There's some solutions, there's some things that we could do to alleviate the pain, get through this period, and then we're going to reap the rewards. Now, I've spoken to you, remember we were going through the COVID period of time, and I explained to you that this was a bridge that we were going to have to cross, and it was going to be great on the other end, and it was. And we correctly forecasted the last recession that we have, and I'm very sure that we're going to be correct in forecasting this upcoming recession. And just like the last recession, where rates dropped and real estate did well, it's going to be the same here, but I'm going to show you empirical evidence so that you can see this for yourself. So let's go to some slides here together. Okay. Now, when we take a look at the items that are going to cause the dynamics, we talked about inflation and recession and the balance sheet runoff. We kind of went through all those already. But history can also help us. So I want to quickly go through some history here. Let's go back to the late 70s. This guy was our Fed chair, just like Jerome Powell today. It was Arthur Burns. He looked smug. He was smug. He saw inflation go from 7% to 14% in 2 years. Can you imagine 14% inflation? And he didn't do anything about it. He thought it was transitory. Do you believe he used the same words? Jerome Powell used the same words and made the same mistake. Isn't that crazy? Well, inflation did go up. And remember what we learned. When inflation goes up, what has to happen to mortgage rates, everybody? Mortgage rates go up. So mortgage rates went from 12 to 18%. Imagine that, right? Tell somebody today that the rate's 5%. They go, oh my gosh, that's so high. Well, you know, look at what it was back then. Now, he didn't do anything about it and caused a lot of pain. But then under Ronald Reagan, this man, Paul Volcker, who I had the distinct honor of spending some time with, what a great Fed chair. He was tough, and he's been called by many people our greatest Fed chair. So what he decided to do was kill inflation and bring things under control. He said there's going to be a period of pain, but we're going to bring things back. And what he did is he took the Fed funds rate that we've been talking about. Now, currently, what's the Fed funds rate? And if you don't know this, this is the price of money. It's the most important price in the world. You really should. If you're in real estate or in mortgages, I mean, think about what your ultimate product is, especially if you're in the mortgage business. What is your product? Is it a mortgage? Well, nobody wants a mortgage. Somebody's going to say, oh, yeah, give me a lot of debt so I can't go out to eat it. No, nobody wants a mortgage. What they want is money. Your product is money, which is why it is really critical that you understand how money works. And today, the Fed funds rate, after being increased by 1/4 point a couple of weeks ago, is at 1/4% to 0.5%. That's the range. So let's call it 1/4% from now. Well, back then it was 11, and he brought it up to 20% in 2 years. Could you imagine that? Today was big debate. Should the Fed raise 1/4%, 0.5%? He was bringing it up 2 points at a pop, and he was successful. He slayed the inflation dragon. He brought it from 14 down to much more manageable 5%. And now what have we learned? When inflation drops, mortgage rates drop. So they went from 18 to 12. Now, that's him taking a 9% increase in the Fed funds rate resulted in a 6% decline in mortgage rates. He was victorious, but not unscathed. We had a recession, and every time the Fed tries to fight inflation, we get a recession. And the stock market dropped by 30%. 20 years later, Alan Greenspan experienced inflation moving up as well from 1 3/4 to 3.5, but he didn't want to be Arthur Burns. He saw inflation push mortgage rates from 7 to 8.5. And he says, I want to take action right now. And he started to hike the Fed funds rate quickly. And within a year, he brought it up almost 2%. As a result, the economy slowed down for the reasons we talked about earlier. Mortgage rates dropped because inflation dropped. Inflation went from 3.5% to 1%, and mortgage rates went from 8.5% to 5.5%. Sparked a big housing and refinance boom. But like everybody else, we had a recession and a terrible stock market. Now, here's our man, Jerome Powell. I've spent time with Mr. Powell, and look, the guy's a good man. He just made bad mistakes. He's watched inflation go from 1.5% to 7.9%. He thought it was transitory, and it's going to go higher than this. And that's caused mortgage rates to rise from about 2.5% to 5%. So let's recap what's going on to make sure we all get this. This is important that you recognize this. Under Burns, inflation goes up a lot. Mortgage rates go up a lot because inflation goes up. Volcker comes in, he starts hiking the Fed funds rate a lot by 9%. Inflation drops a lot and mortgage rates drop. So he hikes 9%, mortgage rates drop 6%, but you got a recession and a bad stock market. Greenspan sees inflation move up, sees mortgage rates move up, he acts quickly, starts to hike the Fed funds rate. As a result, inflation calms down. And as a result of that, mortgage rates drop 3%. So he hikes almost 2% and rates drop by 3%. But again, recession and a bad stock market. Here's our man, Jerome Powell. He's seen inflation go way up. He's seen mortgage rates, because inflation is higher, go way up. He says he's going to get us to about 2% or so on the Fed funds rate. He's only moved it a quarter so far. Let's see if he's successful. That should cause inflation to drop, which should make mortgage rates drop. But it is highly likely we get a recession, and it might not be something that the stock market enjoys either. Now, the last time we had a situation of a rate hiking cycle, the most recent one, started in 2015, about 7 years ago. The Fed hiked rates, and guess what happened to mortgage rates? They dropped. Inflation crept back in, and the Fed hiked again, and mortgage rates dropped again. Then they started their balance sheet runoff, and this is why Lael Brainard's words were so important yesterday. As the Fed starts letting their balance sheet run off, mortgage rates go up, up, up. And when do they stop going up? When the Fed slowed to a more responsible pace of the runoff of their balance sheet. See, crazy adjustment, accidents happen. Modest adjustment, things settle down. And then when the Fed stopped the runoff of the balance sheet, rates came down further. And this was the COVID issue. So this crazy chart, what does it all mean? Well, you've been hearing about an inverted yield curve lately. It's all over the media. So let's understand it so we can explain it, so it's not foreign to us, because your customer will really need you to explain it. So what is the yield spread? It simply means, imagine if you went to the bank and you're looking to buy CDs, and you're shopping around and you see a 1-month CD, a 3-month, a 1-year, 2-year, 3-year, 5-year, 7, and all these options. Now, the longer you are going to take the risk of tying your money up, the more return you expect, right? And that's just like we saw here, this gray line for 2020, where the rate that the U.S. Treasury was offering to buy its bonds and bills and notes, if you bought a 1-month bill, well, you had a low rate of return. If you committed for 3 months, it was higher. 1 year was higher still, and it kept going up. This is a normal yield spread. And it was the same in 2021. You see, each time the maturity gets longer, the return gets higher. So more of an incentive to tie your money up longer. But let's look at the purple line for a minute. And this is what happened in 2019. And what it did was it allowed us to correctly forecast the recession. Isn't this crazy? For 1 month, you get this rate. For 3 months, it's less. You tie your money up for a year, it's less. You tie your money up for 5 years, it's much less. Even if you tied your money up for 30 years, it was less than tying it up for just 1 month or 3 months. That's called an inverted yield curve. Things are upside down. It doesn't make sense. And what this is this is the first clues that the economy is sick. It tells us that something is deeply wrong. It tells us that the Fed, what affects shorter term rates, is pushing up too much. And the longer term, which cares about inflation, is seeing things slow down. That tells us there's a recession coming. Now, where are we today? This one was just did this one yesterday. This is the current yield curve. And it starts off okay. Boom, from 1 month to 3 months to 1 year, pretty normal, to 2 years. But then it starts to move lower. It's inverted here. And what we're seeing is these inversions in the yield curve are telling us that we're about to see a change. And now remember, when the Fed starts hiking rates, if they're successful in slowing things down, the longer end will come down because less inflation. But the shorter end has to be pushed higher because the Fed funds rate's an overnight lending rate. It's going to push this up. So if they go up 0.5%, this is going to jump to here. Notice how it's exactly tracking the Fed funds rate at around a quarter. Another 0.5%, it's going to go to here. And if they continue to hike rates, this blue line will start here and perhaps become similar to what you see right here, telling us that there's a recession in the not too distant future. When do we think it's going to happen? Probably very late this year or first half of next year. So, okay, let's take a look at how inversions have been a great clue. Well, when the 10-year Treasury is above the 2-year, what you see here is you see a green amount here, because a green color, because the 10-year Treasury minus the 2-year Treasury is a positive number. So here, if the 10-year Treasury is, let's say, 4% and the 2-year is 1.5%, well, then your 2.5% is the difference between the two. It's a positive number, all good. And most of the time it's like that. But when it goes negative, these gray areas are recession. So inversion, recession, inversion, recession, inversion, recession, inversion, recession, inversion, recession, inversion, recession. And notice where we are today. Let's take a close-up. A year ago, the 10-year Treasury was 1.6% above the 2-year. No fears of recession. At the beginning of this year, that's 3.5 months ago, it was like 1%. Today, it's inverted. It's upside down. So is there a recession coming? Yeah, we believe so. Now, there's a couple of other indicators. One are oil prices. When you see a spike in oil prices, that tends to lead to recessions. And of course, as you all know from going to the gas station, we've gotten that. But the unemployment rate is perhaps the best recession indicator. It's the most reliable because it's been 100% accurate. Now, you might be thinking to yourself, well, is that when the unemployment rate's high? I know that's kind of what you would think, right? But would it surprise you that it's exactly the opposite? It's when the unemployment rate is very low, at its lowest level, and starts to turn higher. So why? Think about it this way. Things are great. The economy's humming. Everybody's got a job. I need employees to help me. But now when the economy starts to show its first signs of slowing down, well, what's the first thing I have to do as an employer? I've got to let some people go, unfortunately. And those poor folks that I let go, now, what happens to their spending habits? They're not going out to as many fancy dinners or theater or buying clothes or vacations. So the businesses that were dependent on their business see a slowdown. So they have to start letting people go. And the cycle perpetuates. Let's look at this. You go back to the 1940s. When the unemployment rate reached its lowest level and started to turn up, boom, recession. In the 50s, reaches its lowest level, starts to turn up, recession. Again, 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 again. 100% accurate. And here's where we are now, folks. Now, we might not be at the low, but I'd say we're closer to the low than the high, for sure. So what we're watching for is, let's see if that unemployment rate may continue lower for a while, but when you start to see an uptick in the unemployment rate, that's going to be a really clear recession indicator for you. Okay, so what happens during recessions? If you believe, like I do, that we're headed for one, well, let's prepare for it. How about mortgage rates? Well, the last recession, mortgage rates dropped by 1%. The one before that, they dropped by 1 1/8. Dropped here by almost 1%. Dropped here by 2.25%. Dropped here by 5%, and dropped here by 4.25%. So what happens during recessions? Mortgage rates drop. Now think about this. If there's probably a recession coming or recession-like conditions and rates drop, then today's rates at 5% are going to be refinanced. And if you believe, like I do, that it's very likely that that happens within the next couple of years, then should we be doing deals with upfront MI? Should we be paying points? Should we be looking for the lowest rate? Or should we think about, maybe I'll take an even higher rate and paying less in fees, because I know I'm going to have the opportunity to refinance. Look, all those break evens are about 5 years that I told you. So if you refinance within the first 5 years on any of those circumstances that I explained, you'll be better off with higher rate, lower cost. Upfront MI is more expensive than monthly MI because you're going to refinance sooner. It takes 5 years to break even. And paying points to bring your rate down, while it might sound attractive, there's a 5-year break even for the points that you're going to be paying. You'll probably refinance if you don't move by that time. And then adjustable rates too should certainly enter the conversation right now. We'll talk about that. Now, what about real estate? Because you know the media is going to jump all over this. The media is going to say, hey, you know what? There's going to be a recession. That's going to be bad for housing. Well, really? Rather than scare people, why don't we look at the facts? These are all the recessions, the last 9 of them. In the 60s, home prices were flat and then went up after the recession. In the 70s, they went up and up after. Up during, up after. Up during, up after. Up during, up after. Up during, up a lot after. Up a lot during, and up a whole heck of a lot too much after. And what happened here? The recession did not cause home prices to decline. This was the housing bubble. This was 100 LTV loans, no income, no asset, no job, 5 properties for one person that they're not even living in. This was the excesses that we had, which caused the housing bubble. And it was the housing bubble that caused the recession. The very last recession that we had, home prices went up, and as you know, have gone up a lot since then. So probably because rates drop a lot during recessions, home prices hang in there pretty strong during recessions. But you know, the media is gonna always be negative on this because negativity sells. Now, here's our friend Diana Olick. She's been perfect with her forecast. She's been perfectly wrong all along for the last 10 years. And I just want to take out of the hundreds and hundreds and hundreds of headlines that she's had negative about housing and all the others that are out there that have been so negative on housing, whether it's the stories that you might have seen in Housing Wire or the New York Times or Adam Data or Wall Street Journal, wherever it is, let's take a few clips over the years and let's hold them accountable for it. So back in 2015, Diana Olick said, in 2015, there's a housing bubble larger than 2006. Well, really, Diana? Because if you were thinking about buying a $300,000 home, you would have missed out on the following year, 1 year afterwards. There was 5.1% appreciation, and you would have lost out on $15,000. So what did she say the next year? A year later, she goes, we're in a new housing bubble. Well, in the year that followed that, we're up 5.4% or another 17,000. And she says, home ownership doesn't build wealth. Oh, really? Do you know anybody who hasn't built wealth in home ownership since 2017? I'd be like a needle in the haystack, right? A lot of wealth created since then. And in the 1 year after she made this headline, prices went up 6.1% or another $20,000. The next year, she said, it's better to rent than to buy. Really, show me the one person who's been better off renting since 2018 than if they would have bought a home. And home prices went up another 4.1% or $14,000. And then 2019, she said, the housing market's about to shift in a bad way. Well, in the 1 year after that, home prices went up 4%. And her forecast for 2020 was that it's going to be really hard on the housing market. Well, it's only hard if you didn't buy a home because prices went up 11% or $42,000. And then a little less than a year ago, she said, the housing boom is over. Well, team, since then, home values have gone up 18% or $81,000 on this home. Listening to the media is not the strategy. So when your customers come to you with that, this is what you want to be able to talk about. Not just say, I think the housing market's good. You want to show this, but then let's go to the real facts. Look, we take a look at demographics. It's really important. This chart shows how many people born in the United States every year since 1928. Here's your baby boomers, your Generation Xers, and your millennials. According to Zillow, the median age of a first-time homebuyer is 33 years old, and that means they were born right here in 1988 or 89. That's where they were born. Notice that this year's crop of first-time homebuyers is more than last year's, so that means more demand. But next year's will be higher still, and the year after higher still, and it stays above these levels into the foreseeable future. It's always going to be more than the crop we got this year and last year. That means more demand. Now, when I forecasted the housing bubble, I wasn't always bullish on housing. I'm bearish when I should be bearish and bullish when I should be bullish. So when I thought that the housing market was in trouble, in 2006, I had a show on CNBC that I used to be on, and I said, hey, I think that the housing market's in trouble. And I used to get hate mail. Why? Housing market's booming. And I pointed to this exact chart. And I said, in 2006, when we look at people that are first-time home buyers, they were born in 1973 or right here. And I noticed an enormous drop in the amount of births in 1973. And there's lots of reasons, but one of them was as abortions were legalized in 1973, naturally births decreased. And it stayed low for a while before starting to pick up again. Well, we thought that 33 years later, that would mean less demand for homes, less first-time home buyers. And here's the chart 33 years later, and here's the drop to 2006. By the way, this was the fewest births since 1945 or 46, I should say. So when we saw almost 30 years we hadn't seen births that low, we knew it would have an impact. And now 33 years later, you could see the amount of households formed, and it's a hand in glove fit. And here's what the future looks like. Look, hand in glove, same pattern. Look, these people were born and they're coming 33 years later, same pattern. So what about supply? What about builders? So builders, they need to build about 100,000 more homes than demand, because those homes get destroyed, aged, replaced. So it's not uncommon for them to build a little bit more homes than what the demand is, just kind of like this. But in 2006, exactly 33 years after births declined, you get a huge drop in first-time home buyers. But builders built 2 million homes. That's an imbalance. The next year, they did the same thing. And the year after, you had a full-blown housing bubble. But now, if you want to know why the housing market's so hot, why there's no inventory, why home prices are so strong, look no further than this. Look what's happened in the last 5.5 years. Too much demand, too many dollars, and too few product. Now, can builders catch up? I don't know. It's hard. It's really hard. It's hard with supply chains, with regulations, with the cost of land. And it's also hard with semiconductors, chips that go into everything. It's taken you a long time to get your car. You know that. But homes need chips too, because your appliances all run on computer chips. Now, people might point to, and I want you to be careful of this, because they're going to say, well, the new construction market, there's a lot of homes for sale. There's 407,000 homes for sale. But that's for sale. They can't complete them. Out of the 407,000 homes for sale, you know how many could be moved into? 35,000. So speak with facts. You be the advisor. You be the one that's in the know. And look, with all the headwinds, inventory is down 14% from last year. Rates are up 1.5% from last year. Prices are up 18% from last year. Do you know that purchase activity is still at a record high? And speaking of inventory, look at every year for the last 5 years, how the numbers keep going down. There's a buildup of inventory in the summer months, and then it gets depleted. It's just cyclical. Here's where we are right now, lowest on record. And if people say, well, look, it feels like there's a housing bubble brewing. Well, let's compare the housing bubble. That was in 2007. There were 3.7 million units for sale. Today, there's 870,000 units for sale. It's a record low. Where are you going to get a bubble from? And then hold on a second. Households have grown since 2007. Everybody in the United States lived under 116 million roofs. Today, it's 130 million roofs. So there's 14 million more households fighting for 3 million fewer homes. How are you going to have a bubble? Now, look, folks, I'm not saying we're going to get 18% appreciation. I don't want that. But I think it's quite possible that you continue along 5 or 6% appreciation, which is very healthy, and you can create a lot of wealth. That's not a housing bubble. That's enormous wealth creation. Remember that chart I showed you with Diana Oleg's pictures? All those small growths resulting in lots of gains. Also, incomes have gone up, because when people talk about affordability, well, incomes are up 60% from the bubble time. People were making $20 an hour then, $32 an hour now. Let me give you an example. In 2021, last year, people are saying, well, rates have gone up a lot, monthly payments gone up a lot. And I know people are making a big deal about this, so let's analyze it. In 2021, if you bought a home and you needed a $400,000 mortgage, and the rate a year ago was 3 3/8, so your monthly payment would be $1,768 a month, and your average income for a couple would be about $4,500 a month apiece to qualify for that. Well, this year, with homes going up 18%, we have to increase the mortgage amount 18% to be fair, right? So that's a $472,000 mortgage. And let's take more approximate rates for today. Your payment goes up, let's call it $700 a month. That's a big jump. But wait a second. Statistically, the Bureau of Labor Statistics says that the private sector income's gone up 10.5%. That means you're making $945 a month more in income. Now, while there are other things that have gone up from last year to now in cost, and I get that, I'm not trying to say this may be more than enough to cover it. It might come up a little short. It might be enough to cover it with the other things that have gone up. I'm trying to say you have to look at it both ways. If you're going to say the payment's gone up, and it has, well, let's look at the income, because the incomes have gone up too, folks. So let's be fair about this. Now, our housing forecast is for rents to continue to go up. Now, rents have gone up in the last year 17.6%. So that's no picnic either, right? Where are you going to live? You're going to live with mom and dad? I'm not even going to go why that's not a great option. Or you're going to rent and see that go up 17%? Or you're going to own a home. Now, rents should continue to go up. I don't know about 17%, but renewals should go up 7 or 8%. And that's every year. we think that appreciation slows, but still remains high single digits. So on a $500,000 home, you'll probably make 40 or 50,000 appreciation. Don't miss that opportunity. And look, here's one of the things that you should have is you should have an ABM. And we put on ABM and MBS Highway. Why is that so important? First of all, if you're doing a refinance, you want to know what the value is right away. But how about helping real estate agents? If you're a real estate agent out there, how much time do you put in to a couple of things that you have to do? First, bring that customer down to earth on what the value is. And two, pulling all the comps. How many hours of work is that? Well, in 3 seconds, your mortgage professionals, this is what the team over at Finance of America does for everybody, is they give their realtors an AVM, which has all the comps on it, saves them hours worth of work. Who are they going to want to work with? And all the pertinent data on what the expectations should be. And now you can use that AVM because when somebody wants to bid over asking price, no one knows how to figure this one out. People are making decisions on emotion. They're making decisions based upon feeling that they need to be competitive. But let's give them a logical benefit here. They need to know how long will it take for me to break even, and they also need to know what the future holds. So here's a real example in zip code 85008. It's in Phoenix, Arizona, just to pick an area. And the AVM comes in at 401, and they've got their home listed as 399,990. So in order to win this home, they got to go 20,000 over asking. Customer is hesitant to do so, as you can imagine. So they're going to pay $419,000 for this home. How long will it take to break even until the home is worth 419? Well, turns out that in this zip code, based upon appreciation forecasted for this zip code, it's going to take 6 months. 6 months. Customer said in real time, wait, it's going to take me 2 months to close. So 4 months after I close, I'm even. That's not bad. But then let's talk about what the future holds. Now, well, right now in Arizona, they're going up like 25, 30% appreciation. The forecast for average for the next 5 years is 4.76%. How much money is that? Because people have a hard time figuring that out. It's $104,000. Like, wow, that's a lot of money to gain in 5 years. I don't want to miss that opportunity. Is 4.76 a good number? Well, let's give you the last 62 years. Historical average is 4.33%. So yeah, right in line with expectation. This will help you win, team. And then, of course, give them a report card. This takes less than 5 seconds to do, and it will tell you everything you need to know: historical, forecasted appreciation, the value of the home, households being formed, first-time home buyers versus builder data on how many homes are going to put up in the shortage, affordability, incomes, unemployment, job growth, demographics, everything you need to know, co-brand it with your real estate partner. And team, I wanted to take a quick look at the market because it's really improving today, and that's good news. Now, in this morning's update, we do an update every morning for you. We said that this would be coming. We wanted to float today because we thought we could see a turnaround, and so far, so good. We are seeing a turnaround in the marketplace today. So let's keep our fingers crossed that it stays that way. I left a little bit of time for questions